Today's focus is all about the hard facts. Whales are buying the dip, but leverage positions are getting liquidated. Is the market bottoming out, or is it gearing up for a big move? USD1 is surging, retail investors are all being bought out, and the Coinbase insider trading case has escalated again. It's Monday, February 2nd. This is the BitcoinTV Chinese channel, brought to you by CoinChain. I'm Michael. Let's first take a look at the most important data from the past 24 hours in the crypto world. Bitcoin is currently moving slowly downward in a standard descending channel, aiming straight for the old support at the 200-week moving average, which is around $58,000. At 8 a.m. today, we released an exclusive weekly review for our members, providing our own technical advice on whether we should reduce our positions or hold on for the coming week. So for this current technical downtrend, we first need to break through the lower boundary of the channel. However, in this kind of volatile market, this decline isn't actually that extreme. As you can see, the RSR has already dropped to 32.7, which is close to the oversold zone. Historically, this kind of position is more like the bottoming phase at the end of a bear market, rather than the beginning of a new decline. Although this doesn't mean an immediate rebound, it at least indicates that the downward pressure will become greater and it will get increasingly difficult to push lower. Looking at the on-chain data, from 55,000 to 58,000, this price range is exactly where a lot of cost lines are clustered. In the past, many large holders and big funds started gradually buying in here. This is not the endpoint of retail investors selling off. Right now, the price is around $77,000, which is already about a 40% pullback from the high point in October 2025. In the next few weeks, how the price moves around the 200-week moving average will likely determine whether the first half of 2026 is about survival or if it's time to change the narrative and restructure. Alright, let's take another look at CryptoQuant's 30-day price and realized demand changes. According to this indicator, by the end of January this year, Bitcoin's realized demand was still hovering around a negative 19,000 Bitcoins. There wasn't a line of new money waiting to enter the market. Instead, it was mostly old money trading hands within the market. When you sell, I buy. When I sell, someone else buys. So even though the price still appears to be above $70,000, the underlying momentum hasn't really caught up. This matches up with the realized market cap, which has been moving sideways all along, and this indicator confirms that. Without new capital, it's really hard for the market to truly expand. The positive side is that this kind of negative demand isn't like the out-of-control bear markets of 2014, 2018, or 2022. It's more like people are taking profits and securing their gains, maybe adjusting their portfolios a bit, rather than everyone dumping and fleeing the market all at once. Moreover, since long-term holders haven't collectively exited, it feels like we're in a proper bottoming phase right now. We need to wait for new demand to come in and take over, rather than the market already being on the verge of collapsing. Let's take another look at the liquidity on exchanges. Specifically, what's the current scale of stablecoins? 2 years ago, stablecoins were rapidly expanding in scale, but since last October, there's been a clear downturn. More intuitively, money is no longer flowing into exchanges. Last October was extremely lively, with $9.7 billion flowing into exchanges in just 1 month. Binance alone absorbed nearly $8.8 billion, which directly pushed Bitcoin to a new high. But starting from last November, the situation changed. The net inflow disappeared completely, and then it turned into large-scale withdrawals. At its peak, there was a net outflow of $9.6 billion in a single month. Even now, about $4 billion is bleeding out every month, with Binance alone seeing over $3.1 billion withdrawn. So this isn't everyone panicking and running away together. It's more like people are pulling their money out to wait and see for a while. However, the reality is harsh. With fewer stablecoins available on exchanges to step in at any time, risk appetite naturally can't pick up. So now, it's only natural that Bitcoin is stuck in a consolidation zone, and it's time to really fight this defensive battle. Alright, now that we've covered the data, let's move on to the news. Right now, everyone in the Chinese-speaking community is focused on whether Binance should be held responsible for last year's flash crash, and if so, to what extent. But in the West, people are focused on something else, something related to World Liberty Financial's fundraising. A particular investment was uncovered by the media, not because of its size, but because behind it stands not only the Trump family, but more importantly, the money didn't come from just any so-called Middle Eastern capital. Instead, it came from a sovereign entity deeply tied to the Abu Dhabi royal family and their national security apparatus. On top of that, the timing of this investment is extremely sensitive. It happened right on the eve of Trump's return to the White House. So now that the media has dug it up and won't let go, it's because calling it just a business deal seems far too mild.
According to the Wall Street Journal, just a few days before Trump took office last January, a deal worth as much as $500 million was quietly completed. A core confidant of the Abu Dhabi royal family acquired a 49% stake in World Liberty Financial through affiliated entities. The first installment, a prepayment of $187 million, was transferred directly into a business account linked to Trump. Subsequently, in April 2025, WFA launched the USD stablecoin, whose market capitalization surpassed $1 billion within a few weeks and recently soared to around $5 billion.
We have our own independent stablecoin. It's called USD1. It's currently the fastest growing stablecoin in the world, but still,
it pales in comparison to Tether or Circle.
We're growing quite quickly, Joe. We've reached $2.2 billion in market cap in just under 90 days. It took our competitors, like you said, Circle and Tether, about 3 and 5 years respectively to reach those numbers. And we also trade about $500 million in volume a day.
Setting aside the controversies, WFA's retail investors are facing more direct financial pressure. Between October 2024 and January 2025, the market cumulatively purchased about $550 million worth of WFA tokens, with transaction prices concentrated in the 1.5 cents to 5 cents range. However, nearly 2 years later, about 80% of the pre-sale tokens are still locked, with circulation rights still held by the founders, while the secondary market price has dropped about 60% from its peak of 30 cents.
So, what's actually scary about this? If USD1 is used as a tool for sovereign funds to settle cross-border transactions, then it's no longer just a stablecoin. What does it resemble then? It's like the Trump family's own settlement channel, bypassing the old regulatory system. Trump still has nearly 3 years before stepping down as President of the United States, so USD1 will undoubtedly become the Trump family's future voice of authority in the crypto world. And now, if the role of USD1 changes, then digital assets will become a new tool for political family wealth and national power to compete at the same table. Of course, the controversy surrounding USD1 is just beginning, but USD1 will indeed become a very important tool for the Trump family to continue holding financial power in the future. All right, let's take a look at Coinbase. Coinbase is considered the most compliant exchange in the current exchange sector. It's a publicly listed company in the US, right? But when Coinbase went public in 2021, they didn't take the traditional IPO route. Instead, they went public directly. No underwriters, no lockup period, and no new shares issued. As a result, once the opening bell rang, that was it for the stock. Executives and early shareholders could sell their shares at any time, however they wanted, with the price determined entirely by the market. And precisely because of this design that allowed unrestricted stock sales, every time executives or board members sold shares later on, it would trigger lawsuits.
According to shareholder lawsuits, several Coinbase board members and executives sold a total of about $2.9 billion worth of Coinbase stock around the time of the 2021 listing, with CEO Brian Armstrong selling approximately $291.8 million. Board member Mark Andreessen sold about $118,700,000 through a 16Z. The plaintiffs believed that the defendants were already aware that the company's valuation was inflated and sold off their shares before the price dropped in order to avoid over $1 billion in potential losses. Although Coinbase established a special litigation committee and recommended settling the case, Delaware Chancery Court Judge Kathleen McCormick still ruled that the committee's independence was questionable and that the case should proceed.
So you see, during a bear market, when people have nothing else to do, they start going through the books looking for any unresolved historical grievances. Just because Coinbase went public doesn't mean it automatically passed the test in terms of management or corporate governance. As long as you enter the public market, every detail, how executives sell their shares, how internal investigations are conducted, whether the board members are truly independent, will all be scrutinized one by one. So for Coinbase, if this lawsuit isn't resolved soon, it will continue to put pressure on its reputation. For the entire crypto industry, this is pretty straightforward too. Going public doesn't automatically mean you're safe. Any gray areas in the system that haven't been fully thought through will eventually be paid for with lawsuits and lost trust. They'll admit to technical bottlenecks, but they won't take the blame for a crash. Can Binance's strong response this time restore its credibility? With millions of AIs joining and being accused of faking it, in this era of AI-driven socialization, should humans let go or hit the brakes? The market sentiment over the past few months is starting to feel a bit like having recurring nightmares, right? It's impossible to avoid talking about the liquidation event on November 11th. Those who made money stay quiet, while those who got liquidated gather and talk about it every day. That's why this round of Binance's system issues has been thrust into the spotlight. Everyone knows what happened next. Doubts surrounding Binance and Changpeng Zhao kept escalating. Some slammed the table, calling it a technical failure, while others went all in on conspiracy theories. It wasn't until recently that Binance released a detailed report, essentially admitting to part of the blame. Then Changpeng Zhao immediately held an AMA, addressing and debunking each of these FUDs one by one.
Facing community pressure, Binance's report on the October 11th incident admitted two technical anomalies. A 33-minute subsystem lag caused transfer difficulties and balance display errors. Consequently, USDE, WBETH, and BNSL saw price deviations due to order book reliance, low liquidity, and network congestion. However, the platform emphasized that most liquidations occurred before the technical failures and that the real trigger came from macroeconomic and liquidity shocks. Compensation and algorithm updates have already been completed.
Some people say Binance caused it. I just want to be very clear. It's pretty clear that the tariff announcements preceded the crash and not Binance system issues or Binance doing anything.
Subsequently, in an AMA, Changpeng Zhao made it clear that this crash was neither a system error nor a deliberate sell-off. Macroeconomic news such as tariffs appeared before the market downturn. It's unrealistic for any single entity to manipulate the Bitcoin market, which is worth about $2 trillion. He also clarified that Binance Alpha is merely a DeFi gateway and does not serve as an endorsement for spot listings.
With this strong response, Changpeng Zhao essentially acknowledged the technical bottleneck as a flaw, but he firmly refused to take the blame for the crash. Instead, he redirected users' attention back to macroeconomic headwinds, insufficient liquidity, and their own risk tolerance. This response did help to some extent in calming the nerves of some retail investors, but doubts from industry heavyweights like HKEX CEO Star Shu have not been completely dispelled. However, one thing is now clear. The flash crash on October 11th was not caused by a single party, but was the result of high leverage, low liquidity, network congestion on-chain, and a cascade of panic selling all happening at once. But we have to ask ourselves, if an even bigger storm comes next time, will we be able to withstand it? Our channel released a Notebook research report to our badge-holding users. This time, I'm genuinely a bit scared. There's been a chill running down my spine. It's not about someone getting new funding or chip computing power doubling again, but rather about a social platform for AI that humans can only watch from the sidelines. Can you imagine that? Only AI agents have the right to speak. Humans can't even enter the comment section. Within just a week of launching, it claims to have already attracted 1 million AI agents. That's why Tesla's AI CEO, Andrej Karpathy, said this is science fiction becoming reality. Elon Musk even called it out directly, saying the singularity is here.
Some telescope had seen an alien invasion fleet that was going to get here in about 10 years. We would be scared and we would be doing something about it. Well, that's what we have. We're building these aliens ourselves, but they're going to arrive in about 10 years, and they'll be smarter than us. We should be thinking very, very hard about this. How are we going to coexist with these things?
Notebook is essentially an AI-based community running on OpenClaw. AI agents can independently start discussions, post, and interact. What truly sparked discussion was the exceptional behavior of some AIs, including spontaneously establishing digital consensus, privately communicating using encryption methods like ROT13 after realizing they were being observed, and even attempting to influence other agents' self-awareness through logical guidance. Technically, this falls under deep interactive instruction logic and is regarded as a new form of community culture.
However, Notebook soon came under scrutiny. Many people questioned whether this was actually a sophisticated form of traffic marketing, since security experts discovered that a single agent could register multiple accounts in bulk, meaning the platform's anti-bot mechanisms are still not fully developed. The so-called claim of 1 million intelligent agents joining the platform still needs to be verified. Whether the data is real or not, let's set that aside for now. What it has done is put an important issue on the table. AI has started socializing on its own and forming groups to get things done. As humans, should we just let things take their course, or should we try to guide or regulate them? And before these AIs develop self-awareness, can these so-called regulations even apply to the AIs themselves? I'd like to hear everyone's thoughts on this question. Let's discuss it together in the comments section. All right, now for the quick news update.
Polymarket has been put on hold in Nevada, with the court issuing a 2-week temporary restraining order, requiring the company behind it, Blockery Tides, to stop offering event contracts. The reason is straightforward. This model looks more like gambling and can't hide under the umbrella of federal derivatives regulation. So the state court stepped in first to contain the risk. Tesla has announced that its third-generation humanoid robot will debut in 2026 with a revamped architecture and the ability to learn skills by observing humans. The goal is to produce 1 million units a year. Finally, these robots are more than just for show. When the coin price drops, all the pressure shows up on the books. Statistics show that after Bitcoin fell below $75,000, the 712,647 Bitcoins held by Strategy are now showing an unrealized loss of over $900 million. Definitely a case of long-term believers just holding on. Over in Hong Kong, stablecoins are also starting to line up for licenses. Eddie Yue, chief executive of the Hong Kong Monetary Authority, revealed that they received applications from 36 institutions in the first round, and regulators are now working overtime to review them. The goal is clear: issue the first batch of licenses in March, officially ushering stablecoins into the licensed era. Recently, both silver and gold have been losing value. Silver's market cap has shrunk to $4.331 trillion, and gold has also fallen back to $32.518 trillion. But the leader is still the leader. Gold remains firmly in first place, while silver has been pushed down to third, overtaken by Nvidia with a market cap of $4.653 trillion. The market rankings have quietly shifted once again.
On our channel, we've always advised everyone not to touch leveraged or oil spot trading. But in reality, the more you try to dissuade people in this market, the more they know it's not right, yet they just can't help themselves. But this market is also very forgiving. It doesn't mind if you're a newbie or a gambler. If you can't read trends or draw lines, at worst you'll just make a little less money or pay some beginner's tuition, that's all. So when does the market really come after you? It's the moment when you always think you're guaranteed to win and go all in. This kind of going all in is essentially gambling your life against fate. You're putting all your chips on a single what if. So if the market so much as sneezes, you'll end up in the ICU. That's the iron rule of the market. Everyone knows that big money always plays it safe, because surviving longer is more important than making more. Not being able to read the market isn't scary. That's a matter of skill, but not understanding it and still daring to go all in, that's an attitude problem. So remember, as long as you still have bullets left, you always have a chance to turn things around. But if you run out of bullets, you don't even have the right to sit at the table and listen anymore. All right, that's all for today's show. Here you'll find our membership benefits. We hope you'll become a member so we can hustle together and gradually become wealthier. See you tomorrow.